Okay, Chapter 5, Modern Portfolio Concepts. So here we're going to start talking about the 5, 6, 7, 8, and 9 is going to be the really meaty chapters of this book where we really start to look at financial analysis and analyzing stocks and helping you to decide a little bit more intelligently which stocks to buy and sell. In this particular chapter, we're going to look at, so the mic's on, we're going to look at understanding portfolio objectives, and as you understand, anybody who's an art student will understand what a portfolio is. Is anybody here an artist? No. I figured that since you're business students. Like if you had talent, you'd be in the art program or music program. And we're going to look at, we're going to talk about standard deviation again, portfolio return, standard deviation upon portfolio, correlation, diversification, international diversification, components of risk, beta. We're going to specifically talk more about beta and beta coefficient. So a little bit more statistics upon financial information. We're going to look at capital asset pricing model. We're going to talk about the concept, mathematically calculate it. We're going to look at modern approaches for portfolio management. We're going to discuss portfolio betas, risk-return trade-offs within a portfolio, different approaches to portfolio management. And that's really, up until this point, we've really been looking at stocks at one at a time. And the reality is no one owns just one stock. You have a portfolio of stocks, like you're building in the virtual stock market. And I'm very happy to see that many students have exceeded the five trade a week minimum. And even though it's a little counterintuitive, like I will say, trading a lot is not good and won't make you, a lot of money. It seems contrary when you look at the virtual stock market, and that most of the top players have traded a lot, made over 100 trades. And what's funny, I was looking at my game from last semester. One student has made 4,500 trades. If you look back at the game from last semester, I don't know how that's possible. I think he made like a computer program, the robot trade for him or something. But that game is now closed, but before it ended, he got in 4,500 trades. That was over 8 months, though, not the whole. It was open for like 8 months, I think, so he kept playing with it. But the basic concept, for making money with a portfolio is to find a good group of stocks that you like and feel are good investments, a good risk-return trade-off, and a good future potential, and you hold on to them for a long period of time, and you don't actually trade too often. And the only time you really trade is maybe you have some extra money, you want to add a stock to the portfolio, or the fundamentals of a stock in your portfolio have significantly changed where it's just not a good investment anymore. So they say that typically for the average portfolio, you should only be making 1 to 2 trades a month. Now, since we're learning in this class, it's good to make more trades, buy more stocks. I mean, you have $1 million worth of trading power. You might as well deploy it and start maneuvering and buying stocks and, because once you own a stock, you think about it more and you track it more and you understand it better. And once you own it with real money, then you get real serious about that stock and looking into it and wanting to know more about it and applying concepts of this class. That's why this class would be much more effective if the requirement of the class was you to put $10,000 into a brokerage account and actually trade your real money. Because that's when you really pay attention and you really want to know what's happening. When you start losing money, it's painful and you want to avoid that. But can't really. I tried. You can't make that a requirement for the class, so we have to play with fake money. Which is you trade quite differently when it's not your money than when it's your own money. In fact, I usually perform better when it's not my money, because I trust my instincts a little more. I don't back out of positions as fast, and I give things the time to work out. And I just don't really worry about it as much, and it seems to do much better that way. So when you play with your own money, you're a little bit more cautious, and sometimes that little bit of extra caution you take with your own money can prevent you from going into the stocks that are potentially a really good deal. And I still think about different stocks. Chipotle Mexican Grill at $38 a share, I wanted to buy, or Yelp at $27 a share, or a lot of these different stocks I was looking to buy, but I was a little nervous about because, I just wasn't sure But that's what you live and learn. If you can only make 4 mistakes out of 10 trades, you're doing really well. So if you can get 6 good trades out of 10, then you're doing really well. And if you could realize what your bad trades are and reverse them quickly, that's even better. And it's sort of like it's like a garden. You want to pick the weeds and leave the flowers. So the stocks that are doing good, you want to keep in your garden, and the stocks that you have bought that are turning into weeds and causing you problems, you want to get rid of. You never want to have the attitude that I'm going to hold on to the stock so I can prove everybody right that I was right about the stock. If the stock is going down and loses 10, 15%, just get rid of it. It's a problem there. People aren't in your thinking on this stock. Wait for it to bottom out and then start moving up again. Because there'll be a point where it'll hit bottom. One thing that's really disappointing to me is solar energy stocks right now. They're all sort of crashing. You know why? Very, very close. Oil, which is related to gas. But oil is priced in the national market, and that's decreasing, so people don't feel an urgency to. Most people like to get solar panel to either heat their home or provide electricity.
That was my idea as well. Was a couple weeks ago I bought a bunch of solar panel stocks, and the idea that eventually in the industry we switch over to solar panels. Is that a strategy?
Yeah, eventually they'll do well, but right now in the microeconomy, oil is going down, so people are less interested in getting solar panels.
So
Good.
is it the right time to buy solar panels when oil prices go down because the increase in oil?
Probably not. Oil prices will probably continue to go lower and lower, and solar stocks will continue to be in a sort of a little bit of trouble here for a while. It's a short-term thing because eventually we all know we're going to run out of oil and prices are going to skyrocket. But right now, United States did this annoying thing where they found a bunch of oil and became energy inefficient, and now we're going to be exporters of oil. And as of, I think, next month, they become the world's #1 producer of oil, passing Russia and Saudi Arabia. And that has a lot to do with, oil prices going down because now we're not a net importer, we're going to be a net exporter. So there's a lot of supply out there, which is, overall, I think good for the world economy. It could be a little inflationary, but if, I'm liking that gas prices, it doesn't cost me $60 to fill up my car anymore. And it doesn't cost me $1,200 to fill up my heating oil tank at home. So I'm hoping for, I would say if oil goes down to about $70 a barrel, $60 a barrel, that might be the bottom of it. And at that time, it might be a good time to start looking into the solar stocks. Because eventually, we're all going to have solar energy. Because these fossil fuels have to go. So there's really there's a show on Showtime called Years of Living Dangerously, and they have like these big Hollywood people like Harrison Ford and Matt Damon, and they go out and they talk about this environmental issues, and they went to Indonesia, and they're showing that how many trees they're ripping down and forests they're burning, and how much the deforestation of the world's forests are like 20% of the increase in carbon emissions because of the burning of them and the lack of them sucking in CO2. So it's really the acceleration of this global climate change or climate disruption is getting really serious. If I wasn't already very old, I would really be worried, So if you guys don't get involved and change this, enjoy your ever-warming planet. If you don't take any you got to take personal. Everybody in this planet needs to take some personal responsibility for this and do what you can, even if it's something small, like recycling or, walking more, not driving your car as much, or keeping the thermostat down, or, anything you can do, or not supporting companies that are huge contributors to global warming somehow. Everybody, because companies don't care. They want to make money. They don't care, if I pollute the planet, because I'm here to make money for my shareholders, not be a good guy. And that's the sad thing about companies, is that they do what's going to make the most profits for them. So if buying palm oil from the cheapest source in Indonesia and encouraging them to cut down their rainforests, then they'll do it. unless they hear from consumers who say, I'm not going to buy your Ben and Jerry's of palm oil because you get it sourced from illegal deforestation crops. Well, anyway, that's what I learned from watching that show. So how does that affect your portfolio? It can affect your portfolio greatly because, one, if you know about alternative energy companies that are going to be in big demand, that could help. Those stocks could help your portfolio. Or if you know of other industries that will suffer because of this, or other industries that might grow. Maybe fans will become bigger. So find a fan company because it's going to get hotter, and you're going to need to cool off more, or different things. I saw on the news that they created a new type of home energy storage battery for solar panel, so you can actually store more of the power in your house because you can be off the grid, and you can just kind of have your solar panels, store the power in your basement, and just run off that at night, and be sort of very energy independent. I like that idea of having my own energy independence, so in case there's like a blackout or a hurricane, I don't have to worry about the power grid and be subject to whatever rates they want to charge. So certain utilities may be something to short sell. If utilities are going to start losing money because everybody's going to their own power generation, and there's multiple ways to generate your own power, solar, wind, and they also have these fuel cell boxes that they're trying to engineer where there could be a box about this big and it uses hydrogen, and it's sort of like a fuel cell for your house. They can generate a lot of power. So there's a lot of new technologies out there, and the biggest one that many of you missed, including myself this year, would be Tesla. Moving into electric cars, which are better for the planet, for no emissions, less greenhouse gases, and that stock went from, under $50 to over $200 at one point. A huge run up on a company that looks poised to be the leading provider of electric cars. And there are plenty of people who pay extra to drive an electric car just for the fact that it'll help the environment and, reduce the need for gasoline, which will help to have a cleaner planet. Okay. So anyway, the portfolio is, as you know, you can have different orientations for your portfolio. Just like you might have, people have different sexual orientations, portfolios have different orientations. See, I said something outrageous to get your attention after that long-winded speech. And any orientation is fine. We're in a modern society. But generally, people of your age would want a more growth-oriented portfolio because you're able to take on more risks because you have a longer time to see them come true, like a dream. But the idea of the growth-oriented, you don't want if you need that money next year, you could wind up losing half of it in a growth-oriented portfolio in 1 year. So that's why you need at least a 10 to 15-year horizon before you are going to need this money to be involved in the growth portfolio. Because generally 10 years is a pretty safe term on owning stocks for a guaranteed return. And if you're someone who's looking to retire, if you're 65 like me and you're looking to retire next year, you want more of an income-oriented portfolio. Don't worry, they can't see me on the internet, so they don't really know how old I am. An income-oriented portfolio where it generates this is a nice idea. You're not losing any of your money. You have, say, $2 million, and it's generating $60,000 a year for you to live on. So every year you look in your bank account, you have the same amount of money, and it's throwing off $60,000 worth of income for you to live on. Right? Isn't that a nice dream that you could just not have to worry about working and your portfolio generates enough income for you to live on? And you could just do what you need to do or what you want to do, or pursue a career that doesn't pay a lot of money, or join a charity or create a charity, or do something with your life other than having to run in that rat wheel. Do you know what the rat wheel is? It's like that hamster wheel where you get in, and it's like my car payment, my mortgage payment, my house payment, my cell phone bill, my Xbox Gold bill, and you just run this. I got to work to pay for all this stuff, my new car loan, and then as you make more money, you spend more money, and you just never stops. And one day, right before you die of a heart attack at age 53, you realize, my God, I've worked my whole life to pay for things that I don't even have anymore. And I really haven't saved any money. And I've created all this stress for myself, and now I'm dead. This is when your life flashes before your eyes. So having a growth-oriented portfolio is pretty nice. Now, when we talk about an efficient portfolio, we like things that are efficient. I hate wasting time and money. And ever drive somewhere and then it's green and it goes yellow and you speed up to go through it, but you can't quite make it, and there's got to be a camera there somewhere, so you stop. And you get really upset, like this is not an efficient way to get to school. And so portfolios are like that too. You get upset when you're not getting the return that you think you should get. And the more efficient the portfolio, the more closely it is to providing that return in relationship to the risk that you expect. So if it's an inefficient portfolio, you're taking on a lot of risk and it's not really providing the return it should. That's inefficiency. A very efficient portfolio is you're getting the returns are more than you expect in your returns for the amount of risk you're taking. So that's how we kind of measure efficiency in portfolios. So proper and careful creation of a portfolio will make it more efficient, and proper maintenance of that portfolio will make it more efficient as well. And when you do anything, when I do anything, I want it to be efficient. If you're doing homework, or you just don't want to spin your wheels or waste your time. So all of us, I don't know if you're like me, but I want things to work out smoothly, work out quickly. I don't want to, every time I do something, I want to see how can I do this faster, better next time. It also makes you a very good employee. Now, there's different ways to measure risk and return on a portfolio, and we're going to, at some point, I have some handouts where we're going to calculate this. And we want to look at, generally, when we look at the return of a portfolio, we do something called a weighted average, because the assets in the portfolio are not all equal. The assets can be at different amounts. So you can't just take the return of each stock and divide by the number of stocks in a portfolio to get an average return, because the average return is not really an accurate return. You want a weighted average where the bigger positions count more than the smaller positions. And we can also create a standard deviation in our portfolio that will give us a better idea of the distribution or dispersion of returns in the portfolio. Okay, so here's a basic formula for the returns in a portfolio. The first thing is we want a proportion or percentage of the total dollar invested in each asset. So if we had 4 assets, we want to have what we would call W, which is a weight. And it could be, if we have 4 different assets, or here we're looking, it doesn't matter how many assets. We want to, and the way we can find the weight is we could just find the total value of the portfolio, right? And the individual value of each asset. So take asset A, 25,000, divided by a $100,000 portfolio, we know the weight is 25%. So for each asset, we'd calculate a weight, and we'd multiply the weight times the rate of return, and we simply add them together. It's identical to the weighted average cost of capital formula from your finance class. But here, we're using it for investments. And this is something that we can do to easily calculate the weighted return of our portfolio, which is the accurate return. Now, in real life, you won't have to calculate this because the brokerages do this for you. So if you have a brokerage account and you have all these stocks in it, it'll give you a return. Probably on a daily basis, you can see your return in year to date, over 12 months, over the quarter. They'll break it up in different ways for you. Okay. Now, when we talk about assets in a portfolio, we want to look at correlation. And why correlation is important, especially when it comes to diversification. So when we talk about correlation, which is another statistical type of concept, we look at the movements of stock in relationship to each other. So do they move? They all go up at the same time, all go down at the same time. They'd be positively correlated. But if they moved in opposite directions, one stock went up, your oil stock went up, and your solar stock went down, or vice versa, then those would be negatively correlated. And the correlation coefficient is a measure of how positive or negative your stocks are in the movements of each other. So it's an important concept, because if you wanted to be diversified, you kind of want to use two concepts for diversification. One is definitely the stocks are of different industries and different companies. So you have not all your money in this thing. You don't want to buy every stock, say, in the defense industry, and that's your whole portfolio, because it's still not well diversified. But you also want to look at how correlated your assets are. And a very big point of diversification is between stocks and bonds, because they generally operate at different frequencies. Sometimes they both go up together, sometimes they both go down together. A lot of the time they go in different directions. Stocks may go up, bonds may go down. So generally bonds are a good counterbalance to creating a diversified and lowering the correlation of your portfolio. So the diversification is a little bit more useful. So bonds typically go up when interest rates are going down, and interest rates go down when the economy is not doing well. They usually want to lower interest rates to spark the economy. So bonds are on a different path. They're a little bit more sensitive to interest rates than stocks, and they react to them sooner than stocks. So right now we're in a situation where it looks like the economy is expanding and interest rates will go up. Well, that will only encourage right now for stocks to go up, but bonds will get worried about this and they'll start to go down, because that will lower the effectiveness of bonds. Okay, and of course this scale is from a 1 to a -1. That's the whole scale of correlation. So of course 1 is perfectly positive, -1 is perfectly negative, and 0 means there's no correlation. For example, we'll say you two have a positive correlation to each other because you both come to this class twice a week. So there's a positive, and there might be instances where you're walking to the same dorm, or maybe you guys go out to lunch, your friends or something like that. So there's a positive correlation between the movements of you two people. But there's probably no correlation between your movements and someone who's a student in, say, Buffalo. And that's a possibility to be completely uncorrelated. Their movements are never the same as your movements, because you're in two different physical places. Or they could just be a student on campus that could be negatively correlated to you, where you take most of your classes during the day and they take most of their classes at night. So you're in class during the day, they're sleeping in the dorm. At night, you're in the dorm doing homework, they're here in class. So I think everybody gets that concept. And this is just a graphical look at correlation. Perfectly positive, you see they move in the same direction, up and down at the same time. And perfectly negative, they're completely opposite directions. So you want assets that are less, you want to having some positive correlation is okay. You just don't want to be overly positively correlated. So you want some of your assets to offset others. For example, earlier we were talking about solar power and oil and petroleum products. If you built a portfolio that included oil companies and solar companies, they're not so positively correlated. Although there are times when they both go up and there are times when they both go down, but there are a lot of times when one goes up and one goes down. So having an energy portfolio that might include solar, wind, oil, natural gas, coal, these things, you could have be a little bit more diversified within an energy portfolio. So if your assets are a +1 or a 1 correlation, you're not eliminating any risk. If your assets are less than 0, you're eliminating more risk. But if your assets are -1, you've eliminated all risk. All risk is eliminated. But you know what happens when you eliminate all risk? You eliminate all return. So one stock goes up 10%, the other stock goes down 10%, you're still at zero. So having them at a -1 means you have no risk, but you have no return. So you want your correlation hopefully to be somewhere, say, between 0.5 and -0.5, and within that range, because that would be a little bit more productive of a portfolio, and your risk would be more mitigated that way. You don't want to be on the two extremes, on the two sides. And these are just, if you look at asset F and asset G, and you combine them together, your return is minimized and your risk is minimized. So that's sort of the trade-off. If you want to reduce, and that's one thing why you see all these stocks and you hear these 100, 200% returns on these stocks, like say Tesla, and you think, wow, that's I wish I had all my money in that stock. But you know that's not safe. So a lot of people go for these mutual funds or these groups of stocks, and then they learn that, hey, I'm only getting an 8, 10, 12% return, and the market's returning 15%. So sometimes you get a return even less than the average market return, which is pretty common for mutual funds. That's just a trade-off. If you don't want to be wiped out and, one stock having an issue and just, going bankrupt and wiping out all your savings, you have to be diversified. And along with that, you have to accept lower returns. But for most of us, that's a good trade-off. We don't really like the idea of all or nothing. Okay, so if we look at these two stocks, portfolio of IBM and this other stock, it must be I'm thinking they're a bio, I should look them up. I'm thinking they're a biomedical stock. I'm not familiar with this other stock. But anyway, we'll just say they're like, yeah. We'll say it's a biopharmaceutical. Is it? You just looked it up? Okay, good. That's because when it has the word gene in it, it kind of feels like a bio stock. So anyway, we know that the bio stock is riskier. So do you have the quote on it? No, I mean the ask price, the bid. Okay, so at the time of this textbook, it was about 60, and now it's up to 90. And look up IBM, because here at the time of this textbook, they had IBM at about $30. Or is that? All right, you know what? I'm reading this chart, and this is a portfolio risk percentage and portfolio return percentage. These aren't the actual stock prices. I was looking at the... Anyway, we see that the return for the biopharmaceutical is higher. The return here, we'll say, is like 35%, but the risks are also higher, measured by this portfolio risk percentage down here, compared to IBM, which has a lower return but less riskier. So we can kind of use this sort of efficient frontier, or this line here, to kind of map out the risk and return between it. So average these two stocks together, you get a better return at a higher risk, and you have IBM, which sort of be your stabilizing stock, and you have the biopharmaceutical, which is sort of be your bigger, riskier stock. And so the idea is if the biopharmaceutical fails or doesn't do as well, you still have IBM to sort of stabilize your portfolio, and hopefully the steadier returns to IBM over time will make up for any big losses you get in the biopharmaceutical company. Okay, so if you look at that same sort of that same pattern, that must be a correlation. You could also think of this line as like a correlation line, because in the next slide, you kind of see the same line here when we look at low risk, low return, which would be IBM, and high risk, high return, which would be the biopharmaceutical, and pairing them together at different percentages of your portfolio would have a different outcome in the total correlation depending on how much of each stock you have. All right. Now, moving outside the United States, so like we saw this week with Alibaba, having some stocks from foreign countries can also be very profitable. because there are more growth opportunities and other companies outside the United States that are poised to grow faster or have higher returns. So using international diversification will only make your diversification that much better. Now, yes.
I just have a question that was related to the last slide. So, like, if you, like, it's really hard for me to be able to, like, say you have a specific number in investments and, like, you want to calculate your total return, like, how much on 8 billion is 8%. Like, is there an easier way, like, can you just go into, like, one day, like, the mental math of, like, doing that stuff?
That's what this handout's going to do. When we go over the calculations of portfolio return and how in the what the percentages are. So we're going to do those calculations either Wednesday or if we have some time after this lecture. Because you're right, you really want to mentally get your head around that. So I have prepared something for us. So good question, but we'll get to that a little bit later. So internationally, you have different countries run on different economic cycles. So when some countries are in recession, like right now we have like Greece and Italy and Spain in recession. Other countries like Germany, United States, Canada are in expansion. So having stocks from all of these countries will help to better your diversification and lower your risks. But it also lowers your return. You know, if you own, the most diversified you can be is to own every stock on the planet. But that's also going to produce the lowest return. So hopefully as a picker, you can kind of pick and choose the good stocks from the bad stocks and build a lower risk portfolio with a higher return through your stock selection. Yes?
When they say there's a market that has a certain amount of growth, like there's like an 8% growth across the market or something like that, which I don't know if that's a realistic number or not. Does that mean that if you bought one of each stock, you get 8% overall?
No. Because if you bought the same amount of dollars invested in each stock, $100 invested in every stock, not one share, because they're not proportional. They're not equally weighted. And a lot of times when they have that 8%, they're talking about the total market, maybe the S&P 500 or the Dow or the small caps. It depends on what index they're basing that return on. But if you own one share of every stock, you're not necessarily going to get that same percentage return because you want to have an equal proportion of every share. You know, we were going to ask something? Okay. But I think we all agree that if I could get the best 50 companies from North America and Europe and Asia, and I had 150 companies in my portfolio, which were the best 150 companies pretty much in the world, that's going to be a superior portfolio with a lower amount of return. Okay. So, of course, some advantages of diversification. Okay. I thought it was going to be a big boom. You have more investment choices, more potential return, more opportunities abroad. And especially now that the United States is shrinking as far as the world dominance in the financial markets, where we used to be over 50% of the total world's capital and stock and money. Now, as other countries are growing, we're becoming a smaller percentage, and diversification is even more important. Now, into reducing risk and hopefully stabilizing return, you can't beat international diversification. And a lot of Americans were still, and to this day, are slow to internationally diversify and have most of their assets in U.S. stocks. There are additional risks for international diversification as far as currency. Right now, the dollar is strengthening, so it's making the foreign returns seem smaller. And that's, anytime the dollar strengthens, money you earn in another currency through a foreign stock is going to be less when you convert it back to dollars. And generally, investing abroad, especially if you're buying individual stocks, becomes much riskier if they're not traded on the American exchange. That's why Alibaba, symbol, I think it's BABA, Baba, they have their list on the New York Stock Exchange to make it easier for American investors to invest in it. That's how they're able to raise $25 billion. You can't really do that without the New York Stock Exchange, raise that type of money. If they were to list it in a foreign exchange, it's almost very difficult for the average American investor to buy a Chinese stock directly from a Chinese exchange. And if they can do it, but it's going to be more money and it's a little bit more complicated. And some brokerages won't even be able to do it. Now, speaking about Alibaba, they did what they had this ADS or ADR. They made the Chinese stock convertible to be exchangeable and tradable on the New York Stock Exchange through American depository shares. And it's a way of taking a foreign stock and complying to, say, New York Stock Exchange standards, and converting it to dollars, so that way you could trade the stock just like an American company. And it's easier for us. They do that because the New York Stock Exchange has so much liquidity and so much capital. So it makes them more attractive to be listed on the New York Stock Exchange. And it's easier for, still in this world today, majority of the world's investors in stock are United States citizens. They invest the most money in stock right now as far as individual citizens. We're not talking governments. Generally, governments tend to invest in bonds more than stocks. So the United States still has a huge amount of capital that flows from our exchanges. And don't forget, other foreign citizens buy from our exchanges as well. And they're already established, like in Europe and things like that. So it's even easy for Europeans to buy off the New York Stock Exchange. So it's just an exchange where a lot of capital can be raised fairly quickly. They have something called Yankee bonds, which is just a fancy way of saying taking a foreign bond and making it tradable in US dollars. So if you wanted, bonds of other countries generally pay higher interest rates. So if you look at the bonds here at 2 or 3% interest rates, they're not very exciting. But if you want a bond from Argentina that pays 28% interest rates, a little bit more exciting. Although, who knows if they'll actually pay the principal back, but the interest rate on the bond is rather high. And of course, it's probably easy for you just to buy a mutual fund that has a foreign investments. And then plenty of mutual funds that specialize in foreign countries or foreign regions. And that's probably what I suggest for most people who want an international diversification. It's very difficult to get all the financial reports and information on some foreign companies because they have different laws about what they need to produce for investors. So mutual funds do a good job of vetting these foreign companies to be invested in. And many of the U.S. multinational companies, even though McDonald's is a very American company, it often gets attacked overseas when people hate Americans and want to express their hate for Americans that will attack a McDonald's because it represents America. But truth be told, most of McDonald's money comes from overseas, not the United States. So it is a truly diversified company and stock. And, if you have been to other parts of the world, sometimes you're excited, yay, I'm going to China. And you get to China and it's like, oh, KFC, Starbucks, and McDonald's. It's like being in Stony Brook. Why did I come here? So you have all these, Subway, and it's like, why did I travel? There's same stores here that they're back. So the world's getting a little bit, due to this franchising and global brands, things aren't as different when you travel somewhere. I think if you want to see different things, go to a local supermarket. Those tend to be a lot different than a lot of the other goods and products for sale. I always like to check out like a local supermarket in the foreign country. It's always very interesting to see what they have, and I'm always like scared to try. And it's even great. Even around here, we're so diversified. They have there's plenty of markets that are Asian oriented. That there's a good one in, I think there's one in Nassau County I've been to a couple of times. And they bring in all the products from local populations. I think this one is more Korean centered. And they have a lot of Korean imports. And I can't read the package. It's just a surprise when you buy it. Like, will this taste good? I don't know. But you can't go wrong with the candy section. Usually the candy section, sweet is sweet, And they usually have, if you ever go to Australia, they have these things called Tim Tams. Have you ever had one of those? Anybody here Australian or been to Australia or New Zealand? No, they have this like sort of like a cookie candy thing. That's like a Tim Tam that's really good, but don't sell them here. And then sometimes you find Kit Kats that are weird flavors. Ever have a pineapple Kit Kat or strawberry Kit Kat? Here we just get boring chocolate, but in other parts of the world, they have vastly different flavors. All right. So as far as risk, there are two main components, diversifiable and non-diversifiable. So diversifiable is sometimes called unsystematic risk, which means that you can buy more stocks to reduce this risk. So diversifiable just means that if I can get stocks in different countries and different industries, and that'll insulate me from specific problems that may affect any one industry or one country. So I can diversify myself away from this risk. Non-diversifiable or systematic risk, think it's systematic. It's in the system. The whole system is a cause. So a systematic risk, or what we call non-diversifiable, means we can't buy more stocks to get away from it. So something like inflation, economic expansion, contraction, market risk. These are things that owning more stock is not going to help. War, inflation, Ebola outbreak, political events. We're going to have, do you know that there's elections this year? In November? Midterm elections? Yeah. And Congress, Senate, some governors. And they're worried about the Democrats losing the Senate, which would, further complicate things. I actually kind of prefer the government to be gridlocked like this, because historically, when Congress isn't able to pass laws, stocks do better. And this is I've seen this phenomenon. I read about this. It's a true thing that when they look at when Congress and the president's ineffective and can't get laws passed, stocks tend to do a lot better than when they can one party's in charge and they can make a lot of laws, because they generally create risk when they create new laws and new tax laws and new regulations, and they tend the stock market tends to react negatively to when a lot of legislation is passed, because sometimes that generally comes with a lot of regulation for the different companies and industries that cause more costs. So say the government did get their act together and they said, okay, we got to start making more regulation on the clean energy and power plants being able to reduce, sequester more carbon, and cars being more energy efficient, and they pass all these laws, which are actually overall very good for us in the long term. But in the short term, all these industries and all these manufacturers are going to have to pay a lot more money to comply, which means they're going to lose money, we're going to pay more for our stuff, and the economy is going to shrink. So that's sort of like the basis of why we like it when, Okay, so let's talk about total risk is undiversifiable and diversifiable risk together would be your total risk. So beta is a way to measure the undiversifiable risk or the systematic risk. So beta is the most popular measure of this risk. Now the beta coefficient is is a correlation of your stock in relationship to the stock market. And this has a range, from unlimited range of what this coefficient can be. It's not like the 1 to -1 that we're talking about earlier. The correlation coefficient. The beta coefficient can be any number, but the beta for the market is 1. So if your stock goes up 10% and the market goes up 10%, it'd be said to have a beta of 1. So your stock matches the return or the movements of the market exactly. And if your stock had a -1, it could be the complete opposite. The stock market goes up 10%, your stock goes down 10%. But what if you had a negative beta of 2, a -2? Stock market goes up 10%, your stock goes down 20%. A -3, your stock goes down 30%. A +3, stock market goes up 10%, your stock goes up 30%. So beta is a measure of how volatile your stock is in relationship to the stock market. So it can be negative or positive, and generally the range from 90% of the stocks live between -1 and 2. A beta of -1 and 2 is where 90% of the stocks live in relationship to the market. So any stocks that are, the more you deviate from, say, between 0 and 1. 0 and 1 is sort of a safe range. Actually, 0.5 to 1 is probably the safest. And the more you deviate from that, the more risk your portfolio will have. And here is basically what I'm just saying. If you have a beta of 0.5, if the stock market goes up 10%, your stock only goes up 5%. Yeah.
So these coefficients, correlation coefficients are calculated with just the stock price? I guess
Yes, the stock price over generally 5 years. So and the market they're pegging it to. So it's a statistical calculation. No one does it by hand. You use some kind of statistical program or calculator or Excel. And they usually, you can calculate coefficient over any period of time, but usually do, most of them are between 3 and 5 years. Now, let's go back for a second. So if we're going to interpret beta, this is sort of what I was talking about before. You want to, the beta is really based on past stock price movements. So it's not a guarantee of how the stock's going to react in the future, more so sort of like a good guide, but not a guarantee. You know, so if you have the stock market, say, is bottomed out and they're going to start a 5-year bull run, you would want to buy as many stocks with a 2 or 3 or higher beta, because they're going to go up even faster than the stock market goes up. And the same thing's true. If the stock market is going to turn around and start to move lower and go into a bear phase, you may want to sell your high beta stocks and replace them with lower beta stocks. You know, so that way if the market does go down 20%, maybe your portfolio only goes down 10%. And this is something for mutual fund managers because they have to have a certain amount of their assets invested at all times. So you would probably say, well, sell everything if the stock market's going to go down and then buy it back later. But if you're a mutual fund, you can't really, it's not that simple. You would have to really juggle your stocks to manipulate your beta based on where you feel the overall market is going to move in the future. And beta is really easily, it comes on you can get it through Yahoo Finance or most financial sites. You can get it easily, and I'll show you. A lot of times it's either on the key statistics on Yahoo Finance or even on the main quote. I know it's definitely in key statistics. Here are just some random betas that are out of date. They're probably not this level anymore, and you could see that this was closer to the Great Recession than today. So stocks like Bank of America and Ford, which had a lot of volatility at that point, have higher betas. Right. So let's just jump over to Yahoo Finance. And here's a stock we were talking about in the previous class. The yoga apparel maker, symbol Lulu. And it's the market cap is about $6 billion. So it has a P multiple of 25. So this seems like a stock that's going to have a higher beta than 1. So go into key statistics. And this has a beta of 1.46. So definitely a higher beta than 1. Gonna get off that. Okay. So that's definitely the key statistics. You can look at your stocks betas and get an idea of how risky they are. And if you find, it's rare to find a stock with a beta of 3 or higher, as it is rare to find a stock lower than a -1 beta. For a long time, the cigarette companies had a very small beta of like 0.38 because they seem to do the opposite of the markets. When the stock market contracts due to an economic recession, nobody who's addicted to smoking says, I'm going to smoke less cigarettes because the economy is bad, right? Does anybody here smoke? Right? Are you going to stop smoking because the GDP went -2%? maybe you'll get more stressed and you'll smoke more, right? How many cigarettes do you smoke in one day? And how much do you 2 to 3 cigarettes? That's it. You should just bum those off of people, loosies, and maybe pay $1 a cigarette then. You need to get up to be a full pack, because that's a real man, is a full pack a day. You know, that's when you know you've made it as a man. Although most people will never admit that they smoke, but then I can see them outside the building smoking, and yeah, who wants to, point that out? Well, you definitely don't smoke. You're drinking something green, and did you juice that? Okay, it definitely looks healthy. The green or something is. I like to do my own juicing. I do that at home. Vegetables. It takes a lot of effort. I don't always do it, but I feel so healthy afterwards. I saw a new report. This could change your life, what I'm about to say. So pay attention. This new report, I don't know how accurate it is, says that if you eat 3 stalks of celery a week, you have a 50% reduction of your chance to get certain cancers. So look that up online. Don't take my word for it. I'm not a medical doctor. I'm a doctor of love. When it comes to stocks, I love stocks. So the model here, this capital asset pricing model, is we're going to utilize beta coefficient to link it to risk and return and produce a required rate of return based on the market returns and the beta of an individual stock. So this capital asset pricing model, which we will calculate at a certain point soon, we're going to use beta, the risk-free rate, market return to define the required rate of return. So what we want to know for any particular stock we get invested in, what's the required rate of return that we need? Sort of like, think of this as the starting salary you need to take a job, or the amount of money per hour you need. So what is the minimum amount of money you need per hour to take a job today? Not when you graduate, but just today, you're working in school. What do you think is a fair compensation for your efforts in a part-time job? Throw out a number. Yeah, per hour. $12. Yeah, I would say between $10 and $12. So you would want to look at what is the involvement or risk of this job in relationship to that return. So if it's a job where you could just sit behind a desk and do your homework, that's a great match for school, because you can work and get paid, but you can also do homework at the same time. I had a job like that when I went to college. It was great. I did so much homework. It was sick. Although I worked at a gas station overnight, so that's why I had all that free time to do homework. But then it was risky because I could get robbed. I have exposure to gasoline. I could get run over. But the hourly wage I felt was fair enough to compensate for the risk of that job in relationship to how much homework I could get done. So it's basically the capital asset pricing model. Understand? In financial terms, we look at, we want to use beta as our measurement of risk. That's a definable level of risk. And we're gonna multiply it by the expected return of the market minus the risk-free rate. Because the risk-free rate is built into market return and should not be amplified. So we want to remove the risk-free rate. Sometimes it's hard to get that arrow back. We want to remove the risk-free rate because we don't want to amplify that by beta. So we want to take the market return, take out the risk-free rate component of the market return, and then amplify it by the risk of the investment. So if the market return is, say, 7%, after we take away the risk-free rate, and our beta is 2, that's going to give us 14%, but we're going to add back the non-inflated risk-free rate, let's say 3%. So it's overall going to give us a 17% return. So let me go over that again. Say the risk-free rate is 3%. We don't want to amplify it, so we're going to take it away from the market return. Remember, the risk-free rate is already in the market return. So we're trying to strip away the risk-free element of the market return. So maybe we get a market return of, expected market return might be 10%. We strip away the 3%, and we're left with 7 after we take the risk-free rate. If we multiply that by 2, we get 14%. And 2 is our beta, or our risk of this asset. So we should get double the return of the risky part of the market return for this asset. But we want to add back the risk-free rate because we also should be getting that return, just not amplified. It's straight form. So we're not going to increase that by, we're not going to multiply that by 2. We're going to take the straight 3% and add it to the 14% to get the 17% return. So what we're basically saying is take the risk we have that's legitimate risk. Take away the risks that have no, take away the part of the return that's not risky. And just amplify the part of the return that is risky and add the two together. And that will be our required rate of return. So for you, that might be $12. Maybe it's a different job. Maybe the job would be, what's a dangerous job? How much would you need to be paid per hour if you were going to be a worker in the Fukushima nuclear power plant cleaning up the nuclear waste? How much would you want to get paid an hour to do that? It's very risky. You might say, there's no dollar amount that I would pay, I could accept as payment to do that. That's how risky it is. So that's the concept. We could also display capital asset pricing model on a graph, security market line as a representation of the capital asset pricing model. And that is sort of what it would look like as risk as the required rate of return increases. I should say as the beta increases, the required rate of return will increase. So this portion is risk-free. So you see how this doesn't change. So if the risk-free rate was 6%, this is not going to amplify. What amplifies is the risk premium. So as beta increases, this risk premium increases, and that's what we plot on the security market line. So just a graphical representation of what I was saying before. As beta increases, that increases your risk. So the risk portion of your return is going to have to increase to compensate for your higher betas. Okay. So a traditional approach would be emphasize balancing your portfolio using a variety of stocks and bonds, using different industries and well-known companies, that you're comfortable with, is a traditional approach to creating a portfolio. A more modern approach would focus more on statistics, using expected returns, standard deviation, correlation, to put together a combined group of assets that statistically would be the best grouping. And in the statistics, we could create what's called an efficient frontier from all this data, where the leftmost boundary of the set of assets in a portfolio would provide the best attainable trade-off between risk and return. And it's more easier to look at the graphical picture of this. It always reminds me of like a blowing wind on, say, a weather map or maybe an umbrella. But what we're looking at is the portfolio risk at the bottom and the expected returns on the y-axis. And that's the y-axis, right? Y, and this is x. I took math. So stocks back here are not efficient. We're having higher risk. You could agree that F is a higher risk than B. That was a joke. FU, if you don't like it. So the B stock has lower risk, but the same return as the F stock, which has higher risk. So F is not efficient, but B is efficient. T is less efficient, but more efficient than F. So the efficient frontier would really be this sort of stock right here. This O would be the most return you get for the least amount of risk. And then as it bends either way, it becomes a little less efficient. So this crest here, between the stocks between Y and Z that are closer to O are more efficient and have a better return compared to the risk.
So that's based on the utility function, but does it change for every person?
It doesn't change per person, it changes for every stock. Because this isn't person specific, this is more portfolio specific. So you could, if you want to think of these not so much as individual stock, it's probably better to think of each of these letters as a construct or grouping of portfolio assets. So removing or adding a few assets within the portfolio can move you from, say, an E position to a Z position, which would be more efficient.
So my question was that, like, in the utility function, the abbreviated lines, how is this determined?
I don't know. Just ignore those. That I can't comment on. I don't know what the author is trying to say with that. But the basic concept you should take away from that side is that the portfolios on the edge of that umbrella graphic are the ones that are more efficient. And I guess what they're trying to say, if I want to make a guess at that utility, if you have better utility, you're going to have higher returns for your risks. But that's a little out of scope as far as what I'm trying to explain. The portfolio beta is what you could calculate. You take all the betas in your portfolio, you weight them by the amount of asset for each beta, and you can do a weighted average of the betas of the portfolio. So you can get not just a beta per stock, which you can also calculate the beta for the entire portfolio by weighting average all the betas within the portfolio. Now, if you look at portfolio risk, when we talked about diversifiable and non-diversifiable, you see here the sometimes called undiversifiable. I call it non-diversifiable, as many texts do. You see down here that this undiversifiable risk doesn't change. Here's the level of risk. This bottom part here, measured by the blue parenthesis, this blue bracket, doesn't change. So that diversifiable risk you can't get rid of. Here's the number of stocks you own. Owning more stocks will not get rid of this undiversifiable risk. But as far as total risk, owning one stock is going to give you the most amount of risk. As you own more stocks, your diversifiable risk will begin to shrink to around 25, 30 stocks is sort of the end of the reduction of the benefit of this, adding more stocks to your portfolio to minimize the diversifiable risk. So this is really just saying that, we've looked at different portfolios, and generally when you get around 25 stocks, you've mitigated a majority of that diversifiable risk. But you've done nothing to reduce the non-diversifiable risk, because that owning more stocks or less stocks won't help you with that. So if you look at these two portfolios, V and W, we have proportions, which are percentages that always equal 1. And we have different betas for each portfolio. So we would want to take, we would want to get an average beta for the V and W portfolios to make them comparable. And it's not giving me those averages. I was hoping that this slide would actually have the weighted average beta on it, but you could easily take the proportion, the 10% multiplied by, here we go, 10% multiplied by the 1.65. Do that for each of the 5, multiply the weight by the rate or the beta for each of the 5 instances and add them to find the sum of the 5, and that will give you a weighted beta that you can compare. You can kind of look at these two and you can say that V is going to have a higher weighted beta than W because all of V's betas are higher than W's betas. So right away you can kind of do a quick weighted average in your head and say that portfolio V is going to have a higher beta, which means more risk. So the portfolio, the beta of the portfolio works just with the stock. If the beta of the portfolio is 1, it's going to have identical returns to the stock market. So lower beta portfolios are going to be less responsive to the changes in the stock market, which you may want a lower beta portfolio if the stock market is going to go down, because that would eliminate that risk. And this is the same percentage as we talked before, but looking at portfolio rather than per stock percentage changes. So it's as the beta goes up in the portfolio, the change in relationship to the market also increases. Okay. All right, so I would say we're out of time for today, so I will leave it here. We'll continue this next class, and then we'll work on the handout. Till then.